NVIDIA is just pure momentum right now. So when we look at NVIDIA, it's now up to 456. Nothing has changed on the underlying economics. 236 times earnings, 44 times sales. This is the modern equivalent of Cisco back during the dot-com bubble. But you have to keep in mind, from a momentum perspective, these stocks can and will move higher. Stocks moving to new 52-week highs tend to continue to climb. And what you are waiting for is what is known as a paradigm shift. You're waiting for some fund manager who is carrying a lot of money to sit back and say, well, wait a minute, I am not going to pay 235 times earnings for this stock. And somebody else says, well, wait a minute, I'm not paying 230, 225, 220. And that's where the stock starts to fall. It becomes like a reverse auction. That time is not there yet. And one of the other things that I like to point out when it comes to this, the top shareholders of NVIDIA, who are they? This should not shock you. It is a lot of names that are in passive investment funds. There is $11 trillion in passive investment funds. And when these things pull back, when this company pulls back, Vanguard scoops up the stock. Fidelity scoops up the stock. BlackRock scoops up the stock. And what do they do with it? Well, either one, they lend it out to people so that they can try to short it. And then they just collect fees from people who are trying to short the stock. They also, Fidelity, for example, may operate some type of relationship with options exchanges. I'm thinking of TD Ameritrade. Or they put them in ETFs and they get paid 1 to 1.5% to just let people buy and kind of trade a trend, short these ETFs and more options around them, more activity. They're just making money buying and holding it, and they don't care. NVIDIA could fall 55%. They're not going to be forced to sell it. It's passive. It's passive investment. It's really just kind of linked to creating the vehicle that people would want to own or trade for the purposes of making money, and they're just collecting their percentages. This is the business model, and it's significant. So you combine this with zero-date options and people speculating on all of this stuff, and now you have a situation where, quite frankly, the market that we once knew that relied heavily on fundamentals and analysis and rational market thinking, passive investing and zero-date and anything else, particularly algorithms, they're completely disconnected from the valuations. It would take something significant to drive that away, to make these companies be forced to sell it. It would be a COVID moment. It would be a banking crisis. It would be a massive liquidity event, similar to late 2018 or 2020 or China in 2015. But what that means is that if you're looking for when that period comes, it's when momentum goes negative. It's when that reading comes. You don't bet against these names until then.